Our speakers, I'm not really a speaker. I'm going to be hosting, but as you know, head of content investment lead here. I've worked over 10 years in investment in content across different markets in Asia as well as the US. Mr. Robert Schmidt, who is the CEO of United Hampshire Reit, he's got over 30 years of experience in the real estate industry. And so one of his main roles is to really focus on building out the United Hampshire Reit portfolio, looking at the overall day-to-day operations, as well as looking closely with the investment team and looking at financial and compliance personnel as well to meet strategic operational objectives of United Hampshire Reit. So a little bit about ProsperUS before we dive in. If anyone isn't aware, ProsperUS is a digital investment platform aimed at millennials, looking to create a best-in-class service, as well as differentiate ourselves through the use of educational content and really focusing a bit more on the long-term aspect of investing, building that wealth over the long term. So we hope to give you a complete experience across multiple markets and multiple assets. So please do check us out at prosperus.asia. And go open an account if you're looking to build your wealth over the long term. Invest on the go. There we have it. You can download our app either via the App Store or on Google Play. And check out our social media sites, either our ProsperUS site, which is the main one, prosperus.asia, or our social media handles for Instagram, Telegram, YouTube, LinkedIn, Twitter, Facebook, etc. Okay, so without any further ado, I will pass off first to Siu Lu, who is head of IR and sustainability at United Hampshire Reit, and she can run through a few of the basic points before handing over to Mr. Schmidt, CEO Mr. Schmidt. So Siu Lu, over to you.
Thank you, Tim, for your warm welcome and introduction. Good evening, ladies and gentlemen. A big thank you to CGS-CIMB ProsperUS team for hosting us tonight. Thank you for your time joining us at United Hampshire US Reit investor presentation this evening. So for those who are new to United Hampshire US Reit, my name is Wong Siu Lu. I am the head of investor relations and sustainability at the Reit Manager. Together with me, I have our Reit management team, including our CEO, Mr. Robert Schmidt, our CFO, Mr. Gerard Yuan, Finance Director, Ms. Winnie Yap, and from the Hampshire companies, joining us is the head of investment, Mr. Derek Gardella. All of us will be available to answer your questions during the Q&A section. Next page. This is the outline for our session today. I'll start with a brief introduction of United Hampshire US Reit, followed by an overview of our portfolio and the profile of our two reputable sponsors. I'll then hand it over to my colleagues who will elaborate on the trends of US grocery and necessity retail market and key highlights for our first half 2022 financial results. Moving on, next page. So United Hampshire was listed 2.5 years ago, back in March 2020, on the main board of Singapore Stock Exchange. Being Asia's first and only US grocery anchor shopping center and self-storage REIT, we are uniquely positioned to benefit from the robust, essential, non-discretionary spending of US consumers, where our tenants are cycle-agnostic and e-commerce resistant. Unlike the usual multi-story, fully air-conditioned traditional shopping mall that we're used to here in Singapore, the shopping centers in our portfolio are suburban strip center, a niche segment of retail market. They are single-story grocery anchor shopping center with big car park located in the suburb, serving the essential needs of the surrounding residents, just like what you have seen in the American movies. Just to give you an example, who are our tenants? We have grocery tenants like Walmart, Warehouse Club, BJ Wholesale Club, home improvement center like Home Depot, etc. They are resilient tenants and generally not impacted by e-commerce. In fact, during the height of the pandemic, that was probably 2 years ago, approximately 80% of our tenants opened for business because they are classified as essential service provider. At the same time, we also focus on growth. In a relatively short 2.5 years since our IPO, Reit has grown our asset under management by 25% through 3 strategic acquisitions, which are all yield accretive to further strengthen our portfolio. Moving on to the next slide, our portfolio. So this slide actually shows the location of where our assets are, mainly located along the affluent and populous eastern seaboard of the US. We have a total of 23 properties, of which 21 are shopping centers and 2 are climate-controlled self-storage properties spread across 8 US states. Next slide, please. Yep, I would like to introduce you to our 2 strong and reputable sponsors, UOB Global Capital and the Hampshire company in the US, who jointly own the REIT manager. UOB Global Capital was founded over 20 years ago back in 1998. It manages over US 2.9 billion AUM and is the asset management subsidiary of United Overseas Bank, which we are very familiar with, a leading bank headquartered in Singapore, which is in the neighborhood. While the Hampshire company is privately held, fully integrated real estate firm with over 60 years of experience. They own and operate a diversified portfolio of over 150 properties across the US with AUM close to US 2 billion. Both sponsors have developed close partnership for over 14 years since 2008, where they jointly formed 3 funds with over US 1 billion AUM to focus on investing in income-producing real estate in the US. With that, I have concluded a very brief introduction of United Hampshire US REIT, and I shall now hand it over to our CEO, Rob, to bring you through the trends of US grocery and necessity retail market and the key highlight of our latest set of results. Over to you, Rob.
Thanks, Sulu. And thanks for everyone for joining us tonight. I'm going to give just a brief overview of some of the trends we're seeing in the space we play in, which is grocery necessity retail, as Sulu explained earlier. And again, just to reiterate, these are goods and services that the US consumer requires on a daily basis: food, medical, gasoline, home supplies. These are necessity goods and services that do well whether the economy is doing poorly or doing well. And we're seeing that now. We're talking about trends in the sector right now. One of the biggest trends we're seeing is the discretionary sector, where you're talking about apparel, you're talking about sporting equipment, electronics. Those types of sales are decelerating, but the necessity-based goods and services that our portfolio offers are remaining very resilient because it's necessity goods. We can't drive that point home stronger. That's why people come to our centers every day, the large car parks, the convenience, the everyday goods and services. So the first trend we're seeing is a deceleration of discretionary, but resiliency with the necessity goods and services that our centers offer. Another trend we're seeing is with respect to e-commerce. We heard all about it during the peak of the pandemic. People were not leaving their homes and ordering everything online. That dynamic is actually changed right now. The peak of the e-commerce, the height of e-commerce was the second quarter in 2020. Since that time, the growth in e-commerce has been decelerating, and the growth in physical stores, bricks and mortar stores, is actually starting to pick up. And our centers have been a direct beneficiary of that. But the most critical trend we're seeing is the growth and the continued evolution of omnichannel retailing. And the most simplest way to explain omnichanneling is basically retailers providing a multiple number of ways to get their goods and services to the consumer using the actual physical store for fulfillment. And the reason that's important is because it's much more efficient. These stores are near where the people live, near the rooftops. So delivery times are shorter, quicker to get the goods to the homes. And then when people are coming to the stores to buy online or pick up in stores, it's much more convenient and flexible for them as well. So it meets their preferences and lifestyles on a day-to-day basis. And we're seeing some of the biggest retailers adopt these omni-channel strategies. They're being very successful with it. Walmart, Target, to name a few. Targets are called sortation centers. They're adding facilities onto their existing stores to fulfill online orders. Walmart's doing the same thing. Sulu mentioned a retailer called BJ's, which is one of the largest warehouse stores chains in the US. They're doing a lot of online fulfillment as well. 80% of their goods and services are picked up online, picked up in the physical store, but ordered online. So we're seeing this all around. And it's very telling when you're seeing companies like Amazon, Allbirds, Casper, these digitally native companies who came out with just digital options early on, now are opening bricks and mortar stores because they're understanding the need for the US consumer to experience the shopping through physical stores. And then also of note, we're seeing consumers now buy more private label offerings because of the high inflation. We're seeing more basic food dishes are purchased. A Walmart representative recently made the comment that people are trading off deli and meats for canned tuna and hot dogs. That's kind of the space we're in right now. For people looking to save money, and the omni-channeling is the best route to do that. If you go to the next slide, graphically it illustrates what I mentioned earlier. 2020 was the peak of the growth in e-commerce. That has since flipped. Now you'll see how the growth in bricks and mortar stores, as of actually first quarter in 2022, has flipped the script. Now more people, the growth are in the physical stores. And that's the offering that our shopping centers provide, physical store presence with omni-channel offering. Looking at our key highlights for the year, we're all about resiliency. And again, the key ingredient being necessity-based goods and services. But because we have these goods and services that people require, we have the tenants that people are attracted to as well that provide these goods and services. And we have a long WALE. These tenants sign, generally speaking, long-term leases. The 8.0 years is one of the longest WALEs in the REIT universe. On the Singapore exchange, we've maintained a high occupancy throughout the pandemic and as we transition into the next phase of the economy. And then again, that's 67.5% of rents from cycle agnostic, essential, non-discretionary goods and services. Our team in the US, as well as Singapore, provides proactive portfolio management services. We had a couple key dispositions in 2022. I'll get into a little more detail in a minute. We completed now 3 acquisitions, as Sulu mentioned earlier. And we've been actively managing the lease rent roll, which is very critical in creating stabilized returns over time. So we're proactively managing lease renewals, extending out leases to minimize that rollover and increase that WALE. And then we've had a strong financial performance since the onset of the REIT, 7.2% year-on-year positive contribution growth. A lot of that was due to 2 new acquisitions I mentioned, Colonial Square, Penrose. We have very conservative gearing, so we have a less of an impact with the rising interest rates right now. And we have a very attractive high dividend yield of over 9.5%. Looking at the financial highlights. Can you back up, Sulu? Okay, sorry, I covered that. On the financial highlights, 22.6 million for the first half of 2022. which was a 10.6% increase over the net property income from a year prior. The 16.3 in distributable income was a 7% increase over last year's distributable income for the same period. Now, if you look at the DPU, we actually were slightly down 2.91 to 3.05, but if you adjust for one-time events, including some top-up income we had with the self-storage facilities and stipulated damage income that we received from one of the development projects, we actually, if you make the adjustment, the adjusted DPU was 2.88 cents versus 2.54 on an adjusted basis. So we're very pleased after the removal of the one-time events, we actually went up in our DPU. I mentioned the fixed rate debt, 80.5%, conservative aggregate leverage of 38.0%, and interest rate coverage is very comfortable as well at 6.0 times. And then the 96% occupancy is very strong throughout the sector. Looking a little closer at the divestments we made during the first half of 2022, the sale of these two self-storage facilities were really an opportunistic sale for us. We have a situation in the U.S. in the first half of the year where the capital appreciation and especially development deals on the self-storage side were valued higher than the cash flow. So we were able to achieve an opportunistic sale and basically harvest cash equity that was invested in these properties, retrieving a cash return of 2.5%, recycling it and reinvesting it into higher yielding necessity retail at 6.5%. That was very accretive to DPU, and it also had a nice impact on our AUM growth. We took $584 million at the onset of the IPO. We're now up to $732 million, which is an increase of just over 24% in AUM. So we're very pleased with the growth we've been able to achieve, even with some of the economic headwinds we've been facing. Our latest acquisition, as illustrated here, is in Upland, Pottstown, Montgomery County, Pennsylvania. This is a suburb of Pennsylvania. I'm very excited to strengthen our beachhead on the eastern seaboard, and especially around the Philadelphia area, which is the 6th largest city in the U.S. This is a very strong anchor tenant, Giant, which is the dominant grocer in the region. It also has some complementary off-price clothing stores and e-commerce resistant tenants. Very well located, best-in-class center in the northwest region suburbs around the Philadelphia area. We're very pleased with that, and that's going to be the impact of this is going to be felt in the second half of the year with respect to DPU, because we were able to acquire this asset without taking on new debt, without issuing new equity. We did assume a $43 million fixed loan at 3.62%. But we used the capital that we got from the two self-storage facilities, so it's going to have a nice impact on our DPU going forward. Next slide, please. The financial results, I'm actually going to turn it over to Gerard Yoon, our CFO, to give a little more detail on the financial performance for the first half of the year.
Thanks, Rob. Good evening, everyone. Thank you for joining us tonight. This next slide has some charts to illustrate our first half financial performance, which Rob previously shared. As you can see, compared to first half 2021, we experienced very strong growth in our revenue. This was up 18.5% from the previous year. NPI was up 10.6%, and our distributable income was up 7.2%. As Rob mentioned, on an adjusted basis, our DPU was up 13.4% from the previous year. On the next slide, on the capital management front, as of 30th June, 80.5% of our borrowings have been hedged into fixed rate, So our exposure to interest rate fluctuations has been largely mitigated. Our gearing, as Rob mentioned, is low at 38%, well below the Singapore regulatory limit of 50%. And we have a healthy interest coverage ratio of 6 times. We do not have any refinancings due this year, and we have already begun to engage our bankers on the refinancing of our loans, which are maturing in 2023. We are looking to complete this refinancing well ahead of its maturity next year. Next slide. As at 31st August, our dividend yield is 9.5%. This offers a very attractive pickup of between 3.8% to 6.6% over the equivalent government bond yields or the yields on the STI and the FTSE Reit index. On a price to book basis, we trade an attractive 0.82 times. And for our recent first half dividend, which we paid recently, we offered our distribution reinvestment plan for the first time. So unit holders had the option of choosing to take some or all of the distribution in the form of new units, or they could also continue to receive it fully in cash. Now I'll hand over to Derek, who's Hampshire's Chief Investment Officer, take us through the portfolio and asset management highlights. Thank you.
Thanks. Thank you, Gerard, and good evening, everyone. We're very pleased to report strong portfolio performance through the first half of 2022. This would reflect both all the new and renewal leases that we completed, as well as the occupancy strength we saw across both grocery and necessity properties, as well as the self-storage portfolio. As we look at it, for the grocery and necessity properties, we completed 13 leases comprising approximately 150,000 square feet. This would be both new and renewal leases across the portfolio. We were also very pleased about the rental growth as well as occupancy gains that we saw across our self-storage portfolio in Carteret and Millburn. Overall, as we look at the leases maturing across, in particular the grocery and necessity portfolio, we have minimal leasing risk over the next several years, which we continue to evaluate opportunities to explore early lease extensions, as well as addressing the minimal maturities that we do have in the portfolio over the next couple of years. If we can move to the next slide. We always like to show this slide to give the investors a perspective on the idea that our portfolio primarily comprises essential uses and services. And these essential tenancies extend well beyond the grocery and necessity anchors, and also goes into the inline tenancies, which may include liquor stores, pet stores, gas stations, financial services firms, as well as other convenience retail that would be deemed essential. And we're really pleased, that our portfolio on a whole, the majority of our portfolio comprises essential uses, and also that this extends beyond the anchor tenancies. As we move to the next slide, over the last year, we've been able to reduce our tenant concentration risk and increase our tenant diversification. In particular, our top 10 tenants, we expanded the diversification and also reduced the concentration risk, as you can see on the slide in front of us. This is attributable to the acquisitions that we made during the second half of 2021. And as we look at the list, they're predominantly grocery stores, as well as some home improvement retailers and other uses that are predominantly essential tenancies. And we also, within our top 10 tenants, have a WALE of 9.7 years. So we're really excited about the portfolio we've created, and also maintaining that high WALE, as well as expanding the tenant diversification. And now I'll turn it back over to Sulu.
Thanks, Derek. So in United Hampshire US REIT, even though we just started our sustainability journey with the release of our maiden sustainability report in April this year, rest assured that it is our top priority to devote more time and effort to ensure the long-term success of our business in a sustainable and responsible manner. As such, as part of our commitment to ESG excellence, our focus is divided into 3 key pillars. Number 1, environmental stewardship. Number 2, community engagement. And lastly, management oversight. By establishing sound governance, diversity, compliance, and managerial practice, this will help the Reit to create a greater transparency and provide assurance of the integrity of our business. Moving the next slide, please. Yes, so as about our ESG effort, as we all know, sustainability doesn't happen overnight, and the Reit has since developed our sustainability roadmap for the years ahead. As you can see here in the chart, we have made some good progress towards our ESG journey in terms of green energy efficient operation, with the installation of EV charging station, LED lighting, and solar panel. The above initiatives are part of our continued effort to reduce the carbon footprint of our assets, and we look forward to extending this to more portfolio assets and accelerated our commitment for sustainable energy. On the corporate governance front, we are very pleased to be ranked joint 4th in the Governance Index for Trust year 2021 during our maiden year of assessment. The Reit was also granted admission to the SGX Fast Track program in recognition of our high corporate governance standard and good compliance track record. Lastly, on the social front, we want to do our part to contribute to the local communities. As such, the team has made a commitment to clock a total of 100 volunteer hours as a firm. The picture below shows that our employee volunteered at the Food Bank Singapore recently, a non-profit organization for food donation in Singapore, as our small gesture in giving back to the society. With that, I shall now hand over to Rob to bring you through the Outlook section and wrap up the presentation today. Rob.
Thanks, Sulu. As I'm sure most of you are aware, the economy over here in the U.S., as is throughout the world, are facing significant macroeconomic challenges right now. First and foremost, in this rising interest rate environment, the Fed is working very hard to keep inflation in check. They kind of let it get away from them a little bit. As a result, they've been rapidly rising the federal funds rate, which is impacting longer term rates as well, and certainly making some progress and putting some brakes on the U.S. economy. Whether or not the economy is formally going to become in a recession, we don't know yet. If you look at the first 2 quarters of the year, GDP were both negative, which meets the technical definition, but there has not been a formal recession yet. Time will tell. Inflation rates seem to have peaked in July. August was still pretty high though at 8.3%, which was only slightly below July of 8.5%. So inflation is going down, but still being very stubborn. If you look at core inflation and strip away food and gas, actually the core inflation was up in August. So there's still concerns. Fed is taking a real hawkish stance. So we don't know what's going to happen going forward. But what we do know is the labor market, fortunately, has remained fairly tight. There are some signs of slack now. The jobs numbers that came out yesterday was a 14-month low, which actually was looked at as a positive by the market, which is why the market rallied, because they were hoping maybe the Fed would take a more dovish stance on rising interest rates. But at the end of the day, the labor markets are still fairly tight despite some layoffs. Unemployment for August went up to 3.7, but still historically very high. And even though there's been some layoffs with some companies like Meta, Ford, Peloton, there's still some sectors that are hiring. There's still many jobs out there looking to be filled in leisure and healthcare, construction and retail are 3 examples that there's hiring going on. So we really have this recessionary concern out there, but the labor markets are propping up the economy. And even with the slowdown in the economy, as I mentioned earlier, we're very pleased with the performance of the portfolio because the consumer is still feeling very flush. They're still out there. If we go to the next slide, they're still out there buying retail goods. As you can see, the numbers are green across the board. I mentioned earlier about discretionary sales. That was flat month on month, only 1.3% year on year. That's decelerating. But where you're seeing the strength is on the necessity-based side that we've been talking about throughout this presentation. Where it's been tapering again, it's apparel, it's sporting goods, it's electronics, it's travel. But the consumer is still relatively healthy. The savings rate just over 3%, certainly well below where it was peak pandemic with all the stimulus. But the consumer is still spending money, and our properties are benefiting from that spending. If you go to the next slide, in terms of the retail sector itself, the fundamentals are still very strong. There's been very little new supply added to the property sector over the past few years. Retailers are still opening stores. If you look at the 4,300 openings compared to 1,900 closures in 2022, this is the first year since the pandemic. There's going to be more store openings than closings. You only hear about the closings, but there's a lot of dollar stores, off-price closing stores, new grocery stores opening. The retailers are not being intimidated by the recessionary talk that's in the marketplace, and stores are opening. Leasing volume also kind of illustrates the strength of necessity retail. As you can see there, the quarterly leasing volume continues to trend upward, even with all the macroeconomic concerns that are out there in the marketplace right now. If you look at the capital transaction volume through the first half of the year, you can see there, retail overall was a 46% uptick year over year. Now, this was just through the first half of the year. If you look at July and August, sales are starting to taper off a little bit. The high interest rates are starting to have a negative impact on the transaction volume. And from a capital market side, things are starting to slow down. We'll have to monitor that and see how that looks going forward. And now if you look at the self-storage sector, fundamentals also remain fairly strong for self-storage. Things have settled down since the first half when we executed the opportunistic sale of two of our development facilities. But overall, in the New York, New Jersey metro area, the supply-demand balance is still very strong. We're still well below the national average of 6.1 square foot per capita. And what we're seeing since the transition out of the pandemic is longer historical in-place customer rental duration. 50% of customers stayed more than a year pre-COVID, but now we're seeing around 65% of customers staying more than a year. So there's been more stickiness to this sector since pandemic, and the reason for that, one of the reasons for that, I believe, is the new work at home structure that we're seeing in corporate America here. Some companies are requiring some attendance back in the offices, but work from home is not going away. And the majority of the companies are offering combination work from home hybrid environments with more people at home. And the home offices are still prevalent. People need more home and efficiencies in their workspaces. So self-storage is the direct beneficiary of that. Deal volume with retail, as with self-storage, is tapering now a little bit in the second half of the year due to high interest rates. So we'll have to monitor that. But we are cautiously optimistic that the market will open up as we move forward. Lastly, again, two more quick slides, then we'll open it up to Q&A. Do have some key milestones and accolades we're very proud of, to be included in the SGX Fast Track program, joining 94 other listed companies. We ranked 4th in 2021 in the Governance Index for Trust, which is a credit to our commitment to governance and compliance. And then we're very pleased that we just were included on a couple new indices, the iEdge Industries, the SREIT iEdge, and the iEdge SGESG. So very pleased to be more prominent on indexes, which we hope will ultimately lead to more institutional investment and create more liquidity in our share volume. Lastly, just to kind of sum up, we offer a lot of different things to the investors: stable cash flows, really predicated by our long-term leases, long-term WALE, and that's driven with the high occupancy of our portfolio, which continues to strengthen even in today's market. These are high quality assets along the Eastern Seaboard, where 40% of the U.S. consumer is located, which drives the U.S. economy. So good infill locations along the seaboard that offer both yield and growth. Again, the long-term leases provide the income security, but we also have growth. Most of the small shop tenants have annual increases, base rent increases baked into the leases that are fixed. And then most of the tenants are e-commerce resistant and adopt some of the omnichannel strategies that I discussed earlier, offering multiple ways to get the product to the U.S. consumer, with the store itself acting as fulfillment for these products and services. And with that, I will end it and open it up to any questions you all may have that the team can answer for you.
Thank you, Rob, for that. I'll get to the Q&A. We've got actually quite a few questions for the team. I think what we'll do is we'll probably flash them up on screen first, just so that the audience knows, can see the question, and then you guys, the panel, can see as well. Okay, so first question. What is management's plans on handling the debt towers over the next 2 years? Are bankers still lending? And what will the average cost of debt rise to, in your opinion?
And why don't we let our CFO, Gerard Yuen, handle that one, who's been spearheading our efforts on the refinancing.
Thank you so much for that question. We have slightly more than 90 million of debt, which is coming due next year, nothing due this year. We started a very early phase earlier this year already to discuss the refinancing with our bankers. We have a very committed and good group of bankers, both in Singapore and the US. We've been closely engaging with them on the refinancing and making good progress. So I think we're very confident that we'll have it in place well ahead of the actual maturity next year. You asked about the average cost of debt. I think there are a couple of questions on that. I mean, generally what we have seen is that there's still strong support from the banks to lend, especially to our sector, which I think they view quite favorably. What I would say is that on the margin front versus when we took this loan out back in early 2020, maybe a very slight creeping up of margins, but not by a significant amount in terms of the discussions that we're having. Obviously, interest rates have moved. I think that's unavoidable. The interest rates have moved up during that period of time, and we'll see where they are at, when we draw down the new loan.
Just to add to that real quick, there is significant interest, as Gerard alluded to, from U.S. lenders to refinance our portfolio. And the reason is the resiliency of the portfolio and a lot of the characteristics we've been talking about: long-term leases, credit, tenants, stability, income security. So while overall lending is a little choppier in this marketplace, our portfolio has been very well received because a lot of the characteristics we've been talking about.
Thank you, guys, for clarifying on that. Next question. Okay, so at a 9.5% distribution yield, is it even possible to make further acquisitions that are accretive anymore?
I think we're going to have to be very disciplined. Obviously, we don't want to make acquisitions that are not accretive to DPU. I think right now, with interest rates rising, cap rates have not risen as significantly as interest rates have. So right now, it might be difficult to make an accretive transaction, but we are in the marketplace every day. Growth is very important to us. We do have goals to grow the portfolio significantly, but right now it may not be the best time to make acquisitions. We are monitoring it daily. And I will also say that traditionally, in rising interest rate environments, the cap rates ultimately rise, but there is a lag. We haven't seen a lot of the increase in cap rates yet, but as cap rates start to rise, there may be opportunities to make accretive transactions. And when that time comes, we'll be ready to go because we are in the markets every day. There's also potentially some portfolio opportunities where cap rates are at a higher level. They could potentially create creative opportunities as well. So it's a good question. We don't want to be rash in our acquisitions, but it is a focus long term. So we'll continue to monitor the markets to move forward here.
Okay, thanks. Thanks for clarifying. Okay, next question. Do you have unit holdings limits in the trust deed for individual unit holders? Don't know who's best qualified to shine light on that.
Sure.
Yeah, that's probably Gerard's bailiwick. The answer is yes. There's various limits. Gerard, can you shed some color on that one?
Sure. Because we are a US REIT, as in from the tax efficiency perspective, in order to preserve our US REIT status, which is a favorable tax treatment, there is a limit of 9.8% for any single unit holder. So because of that, we have a mechanism. It's the same for all the US asset REITs that you would have seen listed in Singapore. No single unit holder should exceed 9.8%. This is in order to protect the tax status of the REIT.
Okay, thanks. Next question. Okay, so I think we've got a couple of questions on the DPU, obviously, and rising rates. I think one of the popular one is, a lot of questions we're getting from REIT investors right now is obviously rising interest rates, the effect on DPU. I think you've seen some REITs come out and talk about, or estimates from analysts talk about the percentage impact on DPU for every, say, 10 or 20% or 100% basis point hike. Can you guys shine any light on that for rising interest rate first off? And then secondly, I guess any estimated percentage impact on DPU going forward for every 10 or 100 basis points in hikes?
Well, keep in mind, Gerard mentioned that we have 90 million of our debt coming due in March. But as we sit here today, 80.5% of it is fixed. We only have one $50 million tranche that is floating. We do have that calculation, Winnie or Gerard, I think you ran on the impact of the floating rates on that, the current debt stack.
Yes, correct. So to reiterate Rob's point, we're already 80.5% hedged. And in fact, we mentioned it earlier, it's not in the computation, but the loan that we took for Upland was a fixed rate loan of 3.62%. So that's a new loan that's not in the first half results numbers. Having said that as well, you can see in the presentation, in terms of the impact to DPU, for every 50 basis points increase in rates, there is a 0.048 cent drop in DPU. So our current DPU for this period was 2.91 cents. The drop for every 50 basis points rate increase is 0.048 cents.
Okay, thanks. Yeah, I think that's good color for the audience to kind of hear about. Next question. Okay, so I think this is to do with the disposed properties. So what are the top-up costs for the 2 disposed properties? Once included, is disposal gain much less than 10%? And why dispose if the yield for these two properties are considered reasonable and attractive versus the gain?
So let me just jump in on the last question. I'll let Gerard or Derek dig into the numbers on the top-up cost, but why we dispose of these two assets, I mentioned earlier they were opportunistic sales. These were development deals that were only partially through their lease-up period. They were approximately on average 50% leased. They were trajectorying upward in the right direction, but where we're at today, as I mentioned earlier in the presentation, our capital invested in these two assets at the moment was generating a 2.5% yield. We had the opportunity to recycle that capital, take it out and put it into a new retail asset that was generating 6.5% yield. While the self-storage were trending upward and growing, it would have taken probably at least 3 years to get us to the same NPI number that we were able to get from the Upland Square Center by regurgitating that capital immediately. So we felt like the growth that offered on a fairly short-term impact more than made up for the long-term growth down the road of the two self-storage facilities. On the specific costs on the top-up, I'll refer that one to Gerard.
Sure. Maybe I'll start by elaborating and explaining again how the top-up worked. Now, the top-up was actually amount of money that the sponsor, Hampshire, actually put aside in an escrow account for the REIT. The reason is because we were buying these two self-storage properties that were being developed. So at the time of IPO, we still wanted unit holders to have the ability to get sort of the full rental yield from these properties that were being, either in the midst of being completed or just newly completed and ramping up. So the top up was really, Hampshire, the sponsor, putting the money aside and then us paying it out to unit holders, to make up the difference between what the actual NPI on the properties are and what a fully stabilized self-storage asset would be yielding at that point of time. So it was money that the sponsors put aside, and we paid it out over time since the IPO back in 2020. And by the start of this year, the top up had been fully paid out, meaning unit holders had fully received the full value of that top up since the IPO until that period of time. So you would have already benefited from the top up. And I think that links to Rob's point about without the top up, because it's been fully paid out, the actual yield on the properties that we sold would have come down, but we obviously turned it and bought a property that's fully stabilized at a 6.5% cap rate instead.
Thanks, Rob. Thanks, Gerard. Next question. Okay, so I think you guys have kind of partially addressed this with the reduction in unit distribution with the upcoming refinancing of 2023 debts. But what's the current interest rate of those 2023 debts, and what's the likely interest rate upon refinancing? Obviously, I think that's probably a bit hard to foresee, but I guess there's, I think people just probably want an estimation of it.
Sure. I guess like we mentioned, margins would be, probably slightly higher. I wouldn't say a significant amount from that loan. And obviously interest rates have risen since then. When we did the IPO, we entered into a swap at that point of time. I would say interest rates at that point of time were just slightly below 1%. Obviously, the interest rates have gone up significantly since then. And we won't know. Honestly, I don't think we know what it will be, at the point of time when we actually draw down the new loan to refinance the existing loan.
Okay, thanks, Gerard. Next question. Okay, so I think we've combined a couple from the same audience member here. There's a couple on how you guys seek out investment deals. I guess cap rates, they've been expanding with regards to recessionary concerns and higher interest rates. Have they been expanding? Have they been moving higher? Any thoughts on the buyout bid of Store Capital by GIC for $14 billion? And I guess moving on to self-storage, because you guys do have a couple of properties in self-storage, is that an area that you're looking to grow the segment? Because obviously I think that segment did quite well during the pandemic, surprisingly for a lot of people. But I mean, I guess moving forward, is that something that United Hampshire Reit wants to focus on?
Sure, okay. I'll try to field these. Derek, you can chip in as you deem appropriate. How do we seek out investment deals? I mean, Hampshire sponsor has been in the marketplace in the Northeast US for over 60 years. We have a lot of relationships with brokers, investors, developers. We are in the markets regularly. We're very well known. We have a lot of relationships. And, relatively speaking, the open air retail sector is actually a fairly niche sector in the US. And I would say that we see most of the deals in our marketplace. We also see some off-market deals that other investors do not see because we do have the long track record. So we see a lot of product. We work with the brokers, we work with investors, we work with developers directly. An example in the portfolio is Wallington. That was a deal that we pre-committed to with the developer. And once the development risk was taken out of the deal and the construction was completed, we bought the deal. We occasionally look for opportunities like that. But it's generally our relationships. We also obviously also get involved in bidding on deals as well, because a lot of these shopping centers, because of their resiliency, they're very high in demand right now, and their performance has spoken for itself over the pandemic. So we have participated in some bidding situations too, which we sometimes have been very effective in winning as well. The two deals last year, Penrose and Colonial Heights, actually were both won out of bidded deals as well. But we're very comfortable where the pricing ended up. But we'll continue to push those relationships and actively look for deals that meet our investment criteria on a daily basis. With regards to cap rates, as I mentioned earlier, cap rates for grocery anchored centers specifically have remained fairly tight. We're starting to see a little bit of loosening of that now into the second half of the year. I mentioned investment volume has slowed down. There's a lot of sellers who are putting disposition plans on hold because of the high interest rates are deterring some demand. But I will say there's going to be opportunity as well, because on the other side of the coin, there's certain investors who are going to have to refinance because they have debt coming due, and they're not going to be able to afford new interest rates at the higher numbers. So we believe that's going to create opportunities going forward. So we're going to be monitoring that closely. We do feel like rates will start to creep up, and that combined with the relationships we have and debt coming due, we expect there'll be opportunity over the next 6 months. We're going to be tracking regularly. What was the next question? The question came off the board. I see there. There was 4 questions.
Yeah, I think the question was the buyout, the store capital by GIC. Any thoughts on that? And then I guess on the self-storage industry as well, the last one.
Let me take the self-storage one. I don't know the specifics of the store capital deal, but I will say on self-storage.
Comment on that.
What's that?
I'll comment on the store capital one after you go through self-storage, Rob.
Yeah, self-storage real quick. Again, I mentioned the 2 deals earlier. The cap rates that we were able to sell those deals at were basically sub 5% on a projected stabilized basis. Self-storage cap rates, believe it or not, are significantly tighter than retail cap rates. So it'd be very difficult to make an accretive self-storage acquisition right now. We do like the sector. We think there's some good long-term growth in it. It's very stable. There's going to be opportunities in the future, but right now, necessity retail cap rates are actually much more attractive than self-storage cap rates. So in the near term, I don't expect to be making any self-storage acquisitions, but again, markets change, we'll continue to monitor it on a go-forward basis and see if there's opportunities going forward, because we are bullish on the sector. And Derek, maybe you can jump on that store capital question.
Sure. So, you know, as many of us have read, and store capital is a net lease REIT that was just acquired at a 20% premium by GIC. You know, I would say that, you know, we, similar to them, we do have some properties that are single tenant and net lease as well. And I think these types of transactions just highlight the demand for, you know, properties with essential tenancies. You know, one of the other interesting things is, as Rob mentioned about cap rates, for other sectors, cap rates have fallen more over the last couple of years relative to the cap rate decline that you've seen in the retail sector. So you haven't seen cap rates decline as much. There have also been, over the last year, other portfolios that have been absorbed, or other companies that have been absorbed by large scale investors. A couple of US REITs acquired there were a few REIT acquisitions as well as larger portfolios. So, you know, where investors are looking to you know, create a strategic transaction, portfolios create that opportunity as always. And it's clear that it's being seen in this market, continuing to be seen in this market.
Thanks. Next question. Okay, so to acquire new properties on a yearly basis, is it part of United Hampshire's plans, and are these deals easily available? And then secondly, you know, how does your side view the competition from others, since most of the stores are on the East Coast? Are there any plans to go into the Sunbelt area?
So as far as new properties, as I mentioned earlier, I mean, growth is a critical priority for us going forward. We mentioned the accretion situation right now with high interest rates and cap rates. We have to be very diligent and disciplined. But the short answer is yes, we are going to continue to focus on growth. I will say also, though, that we're looking to grow organically as well as inorganically. There's some asset enhancement initiatives that we're focused on as well. Some pad sites that we have the opportunity to develop on additional land. But going back to the acquisitions, we also are looking at potential portfolio opportunities. We're looking at more significant growth rather than one-off growth. We do think there's going to be some opportunities going forward from other REITs, maybe looking to dispose of assets. We feel like the price point for some portfolio acquisitions actually may be more attractive than one-off acquisitions going forward as well. So that's an opportunity we're looking at also. Second question there. It's off the board again. I apologize. Oh, in terms of the location, Sunbelt, obviously it's been the Florida, the Texases, the Arizona. There's been a lot of growth. A lot of companies are migrating to those areas. We've seen a lot of population growth. We're keeping an eye on those markets, maybe a growth area in the future. We still are more comfortable in the East Coast because, generally speaking, the submarkets are more dense, higher barriers to entry for new competition. And there still is some opportunity in the East Coast as well. It's the markets that we're actually more familiar with. So I would say, you know, near term, again, probably focus on the East Coast, but going forward, we definitely would be open to maybe some expansion in the Sunbelt areas. There's a lot of good fundamental growth going on in those areas that we definitely could capitalize on in the future.
Okay, thanks. I think that wraps up the questions for tonight from the audience. So we hope you enjoyed today's session. Please fill out the survey if you have time via the QR code. Help us understand what we can do better in future webinars. And I'd like to thank our guests today. So thanks, Rob, Gerard, Derek, and Sulu for tuning in, and the team at United Hampshire REIT. And I hope the audience found this an informative session with the management team here. So I think with that, I'll just say goodbye and let our guests say bye as well. So thank you, everybody.
Thank you.
Thanks
Thanks for your
everyone.
time.
Have a
Thank you.
great evening and great day. Thank you. Bye.